Marqeta is the leading modern issuer processor that allows enterprises to launch customized card programs that are highly configurable, scalable, and simple. The company recently released Q3 earnings, and right away, the stock rallied more than 18% the following day. However, the stock gave up nearly half the gains within the next few days, probably because of something management said during their investor day. So in today's video, I want to give you a quick update on Marqeta. Specifically, Marqeta's Q3 earnings results, investor day, and what the future looks like for Marqeta moving forward. As always, link to my article in the description box below, and with that out of the way, let's get on with the rest of the video. Looking at growth, Q3 total processing volume or TPV was nearly $57 billion, up 33% year over year. This is really strong growth given the high inflation and high interest rate environment that we're seeing today. And this growth will likely continue over the next few years as Marqeta just announced multiple extensions to its partnership with its largest customer, Block. As part of the new deal, Marqeta will be the default issuer processor for the Cash App and Square debit card programs through June 2028 in existing and future markets outside of the US. So that's really positive news for investors, and that is probably why the stock went up so much after earnings. That said, as I mentioned in my previous video, there were a lot of moving parts in the new Block deal, but just to recap, the Block extension affected Marqeta's financials in three ways. First, the new deal changed revenue recognition from Block, which happens to significantly decrease reported net revenue. Second, the new deal comes with reduced pricing for the Cash App program, which to a lesser extent negatively affected gross profit. And as a result of this dynamic, Marqeta's gross margin will expand. That being said, Marqeta recorded net revenue of $109 million in Q3, which is down 43% year over year, solely due to the new Block deal, but this was offset by strong TPV growth. Management actually expected Q3 revenue to drop by 50%, so this turned out to be less severe than expected. So as a result of better than expected revenue, Marqeta also beat analyst estimates by $13 million. I was expecting some sell-off due to the massive drop in revenue, but instead, the stock rallied 18% plus following Q3 earnings, likely due to the Block partnership being extended. Regardless, net revenue numbers will continue to be distorted in the next few quarters, but the important thing here is that TPV growth remains robust, which reflects the strength of Marqeta's platform as well as client base. That said, I will ignore net revenue growth right now and just focus on TPV and gross profit growth. Moving on, gross profit for the quarter was $73 million, which is down 9% year over year due to reduced pricing from the Cash App renewal timing of certain non-Block TPV, and the company losing 4 lease incentives on 2 of its customers. Despite the decline in gross profit, management do not expect these gross profit impacts to reoccur due to changes in how they approach customer deals and contractual language, so expect gross profit growth to stabilize in future quarters. Gross margin for the quarter was 67%, substantially higher than previous quarters as you can see right here, again due to how the new Block deal is structured, and I think the mid-60s to low 70s is going to be the new baseline for gross margins. Moving on, Q3 net income was negative $55 million, slightly better than the prior quarter's negative $59 million, but because of lower revenue, net margin dropped from negative 25% to negative 51%, so yes, that looks really ugly. Nevertheless, Marqeta is still sitting in huge losses, primarily due to high stock-based compensation, which was $46 million in Q3 or 42% of revenue, which is really high. But adjusting for SBC and other non-cash expenses, adjusted EBITDA was much more manageable at negative $2 million in Q3, representing a negative 2% adjusted EBITDA margin. This is better than last year's margin of negative 7%, so Marqeta seems to be gaining operating leverage. Whatever it is, Marqeta is still severely unprofitable on a GAAP basis, and SBC is still unsustainably high. So moving forward, I would like to see these two metrics improve. On the bright side, Marqeta maintains a strong balance sheet with $1.3 billion of cash and short-term investments and virtually zero debt. As you can see, Marqeta's net cash position has been dropping over the last few quarters due to the Power Finance acquisition, which the company acquired back in Q1 this year, as well as the company buying back shares aggressively. Regardless, the net cash position of $1.3 billion represents 40% of its market cap of $3.1 billion, which is really high. Looking at cash flows, Q3 free cash flow was $41 million at a 38% free cash flow margin. The lower revenue due to the new block deal can go both ways. It can make margins look very low or very high, and in this case, free cash flow margin looks really high due to lower revenue. On a trailing 12-month basis though, free cash flow was just $18 million, so nothing to be excited about here. In terms of its capital allocation strategy, management mentioned during the investor day that the company will primarily use cash in hand for acquisitions and share buybacks. That is exactly what they have been doing with their recent acquisition of Power Finance, as well as share buybacks of around $212 million for 36 million shares ever since the company began buying back shares in September of 2022. To put the share buybacks into perspective, the total sum of 36 million shares repurchased was more than enough to offset new stock issuance since IPO. In other words, the effects of shareholder dilution from high SBC have been completely erased by the share buyback program. In addition, in Q3 alone, Marqeta repurchased 11.5 million shares for $64 million, and as of Q3, Marqeta still has $88 million available under its buyback program. So at this rate, the company is likely to announce another buyback program in Q4, which could be another catalyst for the stock. In terms of outlook, management provided the following Q4 guidance. For net revenue, they expect it to contract between 45 and 47%. For gross profit, they expect the metric to contract between 8% and 10%, with gross margins sitting in the high 60s, as you can see right here. Again, I think gross margin in the high 60s seem to be the new baseline for the company. And finally, they expect adjusted EBITDA margin to be around -3% to 4% in Q4, which means profitability is going to worsen slightly quarter over quarter. So overall for me, there's nothing exciting that I can take away from management's Q4 guidance. More importantly, management provided their long-term financial targets during their investor day, which, to be honest, really disappointed me. In short, expect more pressure on both the top and bottom lines in the first half of 2024 due to the block renewal. However, as Marqeta fully laps the block renewal, expect revenue and gross profit growth to re-accelerate by 20% plus in the second half of 2024, and this trend should continue in 2025 and 2026, as you can see right here. And as for adjusted EBITDA margin, expect the metric to turn positive by the second half of 2024. To be honest, management's financial targets seem underwhelming to me, but here's the most frustrating part. Management expects GAAP net income profitability by Q4 of 2026. Q4 of 2026. I don't know about you guys, but that's 3 years from now, and that's way too long to wait. So while it's good that management's update gave us more clarity on the long-term growth and margin profile of the company, it seems that the transition to growth and profitability is going to take longer than I would have liked. I understand that the company has multiple growth levers, such as having a very low market share in a $15 trillion industry, the growth of the embedded finance market, as well as a strong deal pipeline. But GAAP profitability by Q4 of 2026 is just way too long, and this is quite disappointing for me since I've been really bullish on the company for quite some time. I wanted GAAP profitability in 2024 or 2025, but it is what it is. Then again, Marqeta has a perfect track record of beating estimates, and if they continue to do so, the company might just reach its financial milestones earlier, which could bring more confidence and excitement into the markets. But moving on, as we all know, the stock rallied after releasing Q3 earnings, probably due to the block contract extensions. However, the stock sold off quite a bit in the next couple of days, likely due to the company's investor day. I think investors didn't like the long-term financial targets given by management, especially on profitability, which is why the stock sold off, as you can see right here. That aside, I think all this information that management has provided for us is pretty bullish in the short term. First, both the Cash App and Square debit card contracts are renewed, which means Marqeta's growth is secure for the next few years. 2. Management finally gave long-term financial targets, which is good for financial modeling and projections. And 3. The stock is trading above the 200-day simple moving average, which is the dark orange line right here, which means that the primary trend is up. So despite the stock being up around 70% since its bottom in March, I think these 3 reasons could push the stock higher in the short term, probably in the next 6 months or so. In terms of multiples, Marqeta is still trading very cheaply as the company now trades at an EV to gross profit of just 5.3 times. It once traded as high as 100 times, so based on historical standards, Marqeta stock still looks attractive. I did a DCF model as well, but I won't go into detail here. If you want to look at all my assumptions for growth and margins and whatnot, you can check out my article that I recently posted. Again, link in the description box below. That's it. My DCF model returned a fair value estimate of around $7.35 for Marqeta at the moment, which is slightly higher than my previous estimate given the clarity that we now have. This is also slightly higher than the average analyst price target of $6.83. But despite the undervaluation and my short-term bullishness on Marqeta stock, I won't be adding to my position as I'm already overweight and that GAAP profitability is still years away. In conclusion, I'm glad that management gave us more clarity on the growth and margin profile of the company moving forward. I think fundamental certainty is bullish for the stock, at least in the short term. However, the transition to growth and profitability is going to take longer than expected, especially with GAAP profitability only happening in Q4 of 2026. As such, I'm feeling mixed about Marqeta stock in the next 1 or 2 years. That aside, the company is still growing TPV at 30% plus, the company has no debt, and the company is also buying back shares aggressively to offset dilution. Marqeta still has a long growth runway ahead as the leader in modern issuing processing, but investors need to be very patient on this one as GAAP profitability remains years away. Well, that's my quick update on Marqeta. As you can tell, I'm not as bullish as I was on Marqeta stock. If you want to know a stock that I'm very bullish on, you can click in this video right here. Otherwise, that's all that I have for you today. If you find value in this video, please leave a like, comment, and subscribe to my channel for more investment content. As always, I appreciate you and I hope you have an amazing day. See you guys on the next video.